Hello, everyone, and welcome to the South Florida Mortgage Report. My name is Craig Garcia with Capital Partners Mortgage Services, and thanks for joining us today. Today on the show, we're going to talk about interest rates, what's been going on. We're going to talk about the Fed, the Federal Open Market Committee meeting, which is Wednesday, and then we're going to talk about kind of a strategy that you could employ right now if you've got clients, if you're an agent listening to this, that may be thinking, hey, I'm waiting for rates to get better. And so we're going to kind of talk about those three things today. So we hope you enjoy. Thanks for joining. Please subscribe to the podcast. We appreciate that. And again, I'm solo today. Bill May will be back with us next time. But first, let's talk about interest rates. So the Freddie Mac weekly, primary mortgage market survey, the rate came in last reported at 6.35%. So this has been a nice trend in lower rates. It's been happening really since the beginning of June. The end of May, we were probably, pretty close to 7%. And since then, we've been in a nice little run here where things have been getting better. We've had some weaker employment reports. We've had some, tame inflation reports. And then we had, Jerome Powell's big speech at Jackson Hole that has all been accommodating towards lower rates. So that's been good news for people looking to buy homes. So, so that is great. We're actually seeing people get even better rates than that in certain circumstances. And so definitely good news for people on the interest rate front. Now, Wednesday, this part is interesting. So you get the the FOMC meeting is Wednesday. Powell's going to speak. They're going to cut rates. The market has priced in a 96% chance of a short-term interest rate cut on Wednesday. And not only that, the market right now is pricing in a 75% chance of a cut in October, another 25% cut, and then a 70% chance of another cut in December. Now, we try to tell people all the time that when the Fed does cut, it doesn't mean that mortgage rates are coming down, and we've used the phrase that rates don't wait. Rates don't wait. Mortgage rates don't wait on the Fed to take action. So the fact that the market already, is 96% believes he's going to cut on Wednesday, 75% chance cut of next month, and then in December, a 70% chance cut, that's already priced into the market. That's why we've seen rates been getting better, because they believe that this is where the Fed is going and what they're going to be doing. So if the rates were to get, so if the Fed cuts, on Wednesday, which is everybody expects, then more than likely mortgage rates, because of that, long-term rates, they're not going to really, that's not really going to change anything. So why would rates get worse or get better after after this meeting? Well, it's going to be because of it's always because the market is looking forward and they're trying to figure out, okay, what's the Fed going to do in the future? So if Powell comes out and he starts talking about the fact that they are going to cut rates maybe more aggressively than people have been thinking that they're going to cut, then you'll see these bets, these market bets change right away, and you could see rates get better. If he comes out and says, hey, we're going to cut this time, and then we think we're going to leave, we're going to keep some powder dry and we're going to hang on for a while. And if he paints a picture that looks like he may not cut rates again for a while, and people have the market, which would be different than what the market's expecting, then rates could actually get worse in spite of the fact that he just cut rates, the short-term rates. Because again, the Fed, they control short-term rates. The mortgage rates are longer-term rates, and they are based off of the people who are buying and selling bonds in the bond market. So the other thing that could change, so what he says could change the market's opinion about what they're going to do. There's also a thing, you'll hear this thing about the dot plot, and it's kind of all the Fed governors, they put out what they think that the future rates are going to be, into the future. And so their opinions get kind of revealed to the public too. And if those are out of line with what people were expecting, and that's going to change. So anytime you've got something going on in the markets where that causes something to really happen, outside, with one of these events or one of these information releases, these economic reports, it's always about the market moves a lot when things are different than what people expect. So if everything happens according to plan, not much is going to happen. So we'll have to see what happens and what they say as far as the future of interest rates goes. But it's hard to imagine too many surprises coming out. I mean, Jackson Hole was only 3 weeks ago, and that was a kind of a big surprise for the market where Powell had been really, talking about, hey, we have to fight inflation. We have to fight inflation. He was being very, perceived to be stubborn about it. And then he really kind of, Jackson Hole was very softening of that stance and talking about, a change in the outlook and really more, that inflation seems to be more controlled and that we're really looking at the jobs reports more. And so since then, so it'd be hard to imagine that he's going to change the tone again 3 weeks later. But one can never tell. In line with that kind of sentiment, because there's going to be some people out there that are thinking, hey, all right, well, great. Now the Fed is starting to cut rates. And so now future rate cuts are assured, right? And I'll just wait and hey, not too long a period of time, in the next 6 months or something like that, maybe rates will be better. Well, they might be. And then we might find as other economic reports come out. So every month we have, a couple of big events. Most months, we always have an inflation report, the CPI report. We have the NPF jobs report, and then we have, a lot of months we have the Fed meeting. And so based on those things and what new information comes out in the market, that can change the course of rates. So, and yes, if inflation starts to kind of rear its head, or the economy, the jobs looks like they're going to rebound and start being really strong, you could see the outlook for future rate, changes not materialize like people are hoping. So, but we've had this nice little run. And what I wanted to bring attention to was the idea that if you are thinking, hey, right now, if I'd really like to be a homeowner, like to be a home buyer, whether that's for the first time or a second time. And you're thinking, hey, this next several months, I'm looking for the right window as far as rates go to get into something. I mean, right now we're talking about rates being in the probably, depending on your qualifications, low sixes, upper fives, something like that. If I said, hey, if the rates came down to low fives, would that be something that would, spur you into action? If it is, then what I would say is you don't have to wait for that to happen with the market the way it is right now. We have seen buyers where they've taken a strategy where they've said, you know what, I really would like the rate to be here. And honestly, if you wanted to get a rate in the low fives now, I mean, you can likely get there and have the seller pay to buy your rate down to that level. There are deals to be had right now in the market. If you discuss with your agent, hey, what do you think the likelihood is of me putting an offer on a property in this kind of a price range that I'm interested in and getting a seller concession? So that means if you're paying, $800,000 for the property and you wanted a 2% seller concession, that would mean that you're actually getting a credit at closing for $16,000, 2% of the price. If you use that to buy your rate down, probably going to get you'd be able to get a lot lower rate than what I'm talking about, than what I was just discussing earlier. And so, if you put in a 3% concession and you use that to buy your rate down, you're looking at a rate in the low fives, more than likely. So, depending on their situation and their set of circumstances, but those types of situations are available like today. So you wouldn't necessarily have to wait. You would just have to identify the right situation, the right seller on the right house. And so there's more inventory than there's been in years. And you've got sellers that are flexible. You may not have to wait. You can just make your own interest rate environment right now by a properly structured offer on the property to get what you're really after that would make you excited about doing something today. So anyway, if you want more information on that, definitely let us know. We're happy to walk through a scenario with you. But I thought that was a good thing to share. We are seeing people do it today. They're having success. And anyway, we will be back likely Friday. Bill May should be back with us, and we'll proceed with our normal programming schedule. But hopefully you found that interesting today. Again, like and subscribe. I appreciate you listening, and we wish you a lot of success out there. So we'll see you at the closing table. Thanks.